Well, good morning, everybody. It's Ryan, and it is time for our traders training session this morning. Bethany, thanks for getting me hooked up there. Guys, I had an email this morning that the link didn't work. So we had to jump around and get the right link. And so sorry for the delay, but we're here. Please give me a confirmation you can hear me. Will says, hi, Ryan. So I'm assuming you can hear me loud and clear. Is that right? Thank you, Helen. Thank you, Charles. Good morning, everybody. All right. Well, let's get going here. We got to jump in. I'm really looking forward to this. This one is it's going to be a fun little session, a little bit different, but very valuable, I think. So let's go ahead and I'm going to share out the screen. Let's see. This will stop others screen sharing. Do you want to continue? I guess so. Let's do this one right here. How about that? Okay, so I'm not exactly able to see what you are seeing. Are you seeing a full slide, or are you seeing the presentation mode on the slide, guys? Where the pre-mode. All right, cool. So let me change this out. Let's see, let's do this. All right, now tell me what you're seeing. Same, huh? Well, it shouldn't be. Notes, yeah. Well, let me do it again. Change the screen sharing. Go to this one. Bum, 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 bum. Come on, spinning dial. Come on. Kick it up a notch. Any change? Or is it this in the same? I'm still got the spinning hourglass kind of thing. Just one slide. Yeah, but it's not the presentation. Will? Is it the full slide? So in other words, if I change beauty. All right, there's our disclaimer. You guys should have it all memorized. We know that I am not going to be giving you any advice that is particular to any particular trading stock. This is training, it's education, it is good stuff, but it's not advice. So there you go. I think that will suffice. All right, cool. Calendar, upcoming events, phenomenal content. We got Brandon coming up. Rob's got events coming up, tons of stuff. Let's jump into this. All right, guys, this session was called about market maxims. Do they work? What's the deal? And the bottom line is, ever since I started trading, I've been bombarded with the next market maxim. At least it did for a long time, till I basically heard all of them. But it was like somebody would share a secret with you, and you go, oh my gosh, that's wonderful. Because it seemed like it was a product of, it's acquired knowledge. It's acquired knowledge that's a product of other people who know a whole lot more than you do, their experience and their wisdom, because it gives you an insight into, oh, wow, this is something to live by. They would give you some piece of advice that sounded like it was very sage. And because, again, you're getting started and everybody seems to know more than you do, you just swallow it. And there's a lot of stuff I swallowed that I wound up disgorging back up and going, that's not right. That doesn't make sense. So in that spirit, I thought, well, let's go through some of the adages that are out there in the market, and let's find out which ones work, which ones don't, which is good advice, which is not good advice. And we certainly won't touch all of them. There's way, way too many. But I hope to end this on a very powerful piece of advice, and that is my advice. All right. Okay, so let's start with one of the most popular ever, and that is the Santa Claus Rally. What is the Santa Claus Rally? Well, it's almost, I jokingly would say, what is it now? The Santa Claus Rally was discovered in the 70s by an analyst who seemed to notice a pattern. Well, I'm a pattern kind of guy. I like patterns. That makes sense to me. And the pattern he noticed was that right after Christmas, the next basically 6 trading days, from December 25th, the next trading day after, until the first 2 trading sessions, which is the first 2 trading days in January, there seemed to be a rally. Well, okay, years go by, you start accumulating data. It's not just an observation by a stock market analyst. It looks like, hey, there might be something here. So though past results can never guarantee future, you got to put that disclaimer in. And the data seems to support that these rallies happen during the time more often than not. Okay, so we've talked about this kind of thing before in making decisions. The fact that something has a better than 50% average means that, for example, if it's a 60%, 6 out of 10 times this works. Sometimes we forget to realize that 4 out of 10 times it doesn't. 6 versus 4, yeah, there's an advantage, but how big an advantage? Remember, Trip. I'll share what Trip just said because it hits the nail on the head. But remember, Las Vegas has less than 2% advantage. At least I've heard that, and it may be true. The point is that it doesn't have to have much of an advantage. Las Vegas will give you a 48% chance of winning and only a 52% chance of not winning, of actually losing the money, because it is winning and losing when you're gambling. So when you look at that, you say, well, that means that there's almost a 50-50 chance I'll win. I'll do that for that big potential reward, that big potential gain. But you know what? Over time, the house wins. Las Vegas wins. The casinos win. They make tons of money. Why? Because they have a 2% advantage. And they say, no problem. Somebody might win now and then. They may win big. But over time, all we got to do is have a 2% advantage and we win. Okay? So if something is slightly better than 50%, you could say, well, the averages are there. Well, okay, fine. Does that mean you're going to put good money into a Santa Claus Rally attempt when you're going to lose a good percentage of the time? Not more than half. But you guys remember that I've taught you that the great traders, the good traders, are the ones who make their money on about 20% of their trades throughout the year. You only have to have a few bad trades that go really bad to wipe out a whole bunch of good trades that you made a little bit of money, right? So you got to be careful with this stuff. Since 1950, the S&P has returned 1.3% during the Santa Claus Rally periods. That sounds kind of impressive. Like I say, it sounds good. But since the launch of the S&P 500, the SPY, in 1993, the Santa Claus Rally has produced 18 out of 27 times. Okay, I would say that the average information from 1993 forward is more important than the 1950s. Guys, we're traders. We're not long-term buy and hold only investors. And this is trading advice. This is a 6-day window. So since 1950, okay, 1.3%, but since 1933, a more relevant time period, 18 out of 20, or 67% of the time, it advanced. But all of the other 6-day trading periods since 1950 to 1993, any 6 days that you want to put together, the average return is 58%. Okay. So my advice or my feelings on the Santa Claus Rally is, number one, it's not only the Santa Claus Rally that they're talking about. There have been two other variants. And now when you talk about, when you talk to traders about Santa Claus rally, it's not just those 6 days. There's the rally, they still call it the Santa Claus rally, that goes from Thanksgiving till January 1st. There's another one that talks about the week before Christmas through the middle of January. So all it means is that towards the end of the year, there seems to be this behavior. Well, okay, so dig a little deeper, and what do you find? Guys, what you find is that there is another phenomenon that ties into this, which is, we'll talk about this later, and it's the October repositioning. The repositioning that happens in the last quarter, the end of the year, where they do window dressing. And then what they do right at the very end of the year, and we'll explain when we get there. Okay, you'll see how it ties together. Tripp says, and this is the beautiful thing, I appreciate him saying this, they happen for sure right up until the time that they don't. That's right. It works right up until the time it doesn't. Will says they claim the slots pay out 98%. So they're really collecting 1.05 of all the coins put in. There you go. All right, let's talk about another one here. Whoops, let's go the right way. Just for the heck of it, Ryan, quit pushing the button. There we go. Sell in May and go away. Now, we just had that. In fact, we're in the tail end period of this yearly market event. Okay? This yearly market event where there is this tendency for people to say, hey, there's nothing really going to happen over the next 6 months that's worth risking anything. Let's just put things on hold. Let's sell the things we're worried about, and we'll pick it back up at the end of the year. Okay? So, sell in May and go away. Why? Well, since 1990, the S&P has had an average return of about 2% from May to October. However, it averages 7% from November to April. So why bother trading between October and May and October? Well, because it's a generalization. The pattern didn't hold in 2020, and it's likely to be outweighed by more pressing considerations in other years, which means there's all kinds of market conditions that will make this not work. And I'm going to show you that. Investors could try to capitalize on the pattern by rotating into less economical sensitive stocks from May to October based on this data. Okay, fine. Those are nice, pretty little maxims that mean absolutely nothing. Besides, we're traders. We're not looking at whether or not we're going to hold something through those periods. We're looking at whether or not it's worth trading. Check this out, guys. Since 2011, and again, you're going to get the coup de grace at the end of why I'm looking at this. And I really don't care what happened in the 70s and the 80s and the 90s. Since 2011, look at the returns that would have been received or generated during May to October. In 2011, it went down 8%. Oh, wow. Well, in 2012, it was only 1%. See, it's holding. 2013, the market rallies 13 or 10% during those months. And you go, oh, well, wait a minute. That sucked. We were out of the market. 2014, it goes up 7%. Oh my gosh, we're missing out. So you jump and you say, I'm leaving it in 2015, and it goes down 0.3%. Oh man, 2016, 2.9%. Okay, well, it seems like we're back to normal. All right, I'm selling in May and I'm staying out. 2018, 8%. What? All right, it's swinging again. I'm going back in. 2018, 2.4, 19, 3.1. Oh, crap. Okay, I guess the Maxim actually works. I'm not trading during May and October. 2020, 12%. What? What the crap? Sorry. But you see the point, guys? If you average things over a long period of time, you come up with a number. But what does it actually mean? And I would argue that the last 10 years of data, and by the way, in 2021 and now in 2022, it has also not followed the pattern. So in summary, the historical pattern is undeniable. Its predictive power is questionable. And the opportunity costs of believing that, low to hooey, can be significant. So what does it mean as a trader? Nothing. It means you trade the market. If it's going up, we trade the market. If it's going down, we trade the market. If it's flat, yeah, we may sit out until it starts moving again. But these maxims can be dangerous if you just swallow them, guys. That's the whole point. Barry says, market professionals used to go on vacation in May. Today, we use computers ourselves and pit workers are less important. That's exactly right. That's the way it used to be. So I don't care about an average that stretches back over the last 50 years. I really don't care because it doesn't mean anything to me. Here's the next one. October year-end rotations. The fourth quarter window dressing. Could have spelled window right there. Tends to start in October. Generally, guys, what happens is managers want to make their portfolios look good for the end of the year. So they start rotating out of the higher risk vehicles that they've used to generate the higher returns. And I was rushing on this. Apparently, it didn't. My spell checker didn't pick it up. During the year, they want to enhance their returns, but they want the portfolio to look different at the end of the year because that's when they have to report what did you have in your portfolio at the end of the year in the fourth quarter. So the more traditional, better fundamental stocks, they look better. So they rotate into the S&P 500. They will go back into the Dow stocks. For example, then you will see a lot of tech companies slump towards the end of the year. Why? Because if they're the higher risk, higher volatility, more sexy stocks to play, a lot of portfolios rotate out of them for a month or two. And then they go right back in. So then we have a rally that typically happens January or February. We get a little rally bounce in the market. Why? Because they're simply rotating back. It's not that complicated. Does it affect trading? Yeah, it does. Could you use this if you're seeing a tech stock that you play start to slump in the fourth quarter? What do? You look back over the last 5 years, 6 years, 7 years. And if it tends to do it every year, if it's done it 6 out of 7 years, you got something. If it's 4 out of 9 years, yeah, it doesn't mean anything. But what if it's 6 out of 7, 5 out of 6? Now you've got something that you could anticipate. Now you got something you could actually play off of. Does that make sense, guys? This may just seem like it's common sense, but when you're looking at this day by day and you're listening to the stupid news, you can get sucked into these things. Oh, we're looking for this. Guys, remember, CNBC and Bloomberg, they have to fill a 24-hour news window. They got to find stuff to talk about. There isn't that much every day that's absolutely interesting and relevant. So they have archives of stuff that, well, in May, we talk about this. In October, we talk about this. Does it matter? Well, not this year, but we got to talk about it because we got to say something. We got to fill the slot. So if you're watching, reading, be careful. Recognize these people are literally trying to fill time. So they'll talk about stuff because it makes it sound interesting. Maybe it hasn't worked for the last 5 years. Maybe they'll even say so, but they'll still spend time talking about it. So be careful. Let's talk about one of my favorites. This thing has got a huge market sentiment, it has a powerful market effect, okay? And that is the history of Big Bad Wolf. October surprises, October market crashes. Guys, if it happens even close to October gets blamed. Why? Because, well, starting clear back in 1907, 1929, 1987, we've had some spectacularly disastrous moves that happened in October. 2000, 2007, and some people will say, well, you can look and there's this cycle of every 7 years, every 12 years, whatever. Yeah, maybe for a couple of rotations, but if it isn't that consistent, you can't lean on it. You want to lean on a handrail on a 6,000-foot cliff. What if it breaks? Just be careful what you lean on. Historically speaking, however, September has had more down markets than October. Did you know that? I didn't until I read this and studied it, and sure enough. But because you had some really catastrophic big moves in October, nobody talks about the fact that September often has more market turndowns. So what's the deal? October, November, December. October is the beginning of the rotational, the market rotation. Is there a connection? I don't think so. I haven't seen it. But I've seen people try to make the case, but I haven't been able to duplicate it or verify it. But it's tempting to try to connect dots, even when they don't connect. Ooh, this might be this. It might be that. Yeah, it might. I'm not leaning on that handrail. The psychological effect that causes some traders to blame October for stock market declines may actually make it one of the better buying opportunities for contrarian investors. Guys, yes, there is the risk, and it's usually several years apart. I've never seen them closer than the 7 years between 2000 and 2007. But if there is a pullback in September, I've seen many times that October starts a rally. And people that are afraid about an October collapse miss the rally that goes up into November. Okay? It's just, guys, you have to take this stuff with a grain of salt. Some of it, you can get some value out of it. Some of it, you're going to be stretching really hard to get any value out of it. Okay? All right, let's start into some of the more popular ones. And guys, I just got a text. I have a crisis situation that has got to be resolved that I've been worried about this morning that will take me about a minute, 2 minutes. We're at the bottom of the hour. We're almost at 9:30 my time, 12:30 on the East Coast time. Can we take about a 2-minute break and let me put this fire out? I will be right back. I apologize, but this just literally developed as we were in class. So the timing was just bad. Is that okay with everybody? All right, give me 2 minutes. Okay, I'm back and the problem is solved. Yay. All right, here we go. Let's talk about the trend. This is fun. Make sure you can hear me. There we go. All right, so I love this one. The trend is your friend. I agree with it, but here's some things that are really important. All right, some traders believe that smart investing comes down to behaving differently than everyone else in the market by bucking the trends. However, price trends are a reality representing collective actions of all the market participants, and rebels often get risk of running over if you're fighting against the crowd, swimming against the stream. You're trying to pick things, time things. And you better be right because you're going against the trend, right? When the broad market is trending, so most of the stocks are in it rather than fighting it, the direction is to go with it. I don't disagree with that, but there's limits. Okay, here's my but, here's my yeah, but. Patterns in trends, any direction, up or down, tend to go 3 to 5 times. It's true. Going as many as 6 or 7 is possible, very rare. You cannot identify a trend. You can't firmly identify a trend until it's in its 3rd rotation, which means by the time you identify it and jump into it, it can be over. Right? That's the risk. We're short-term traders, not long-term traders, typically. Okay? And that, again, depends on how you define short-term. Short-term might be jumping in with Brandon. You're in and out 2 or 3 times in the morning and you're done. Okay. Short term could be I'm only in it for 3 to 5 days at a time. Great. Short term could be day trading where you never hold a position overnight. You know, you may hold it during the day for hours and not minutes, but you don't stay in overnight. Short term could be I only trade 2 or 3 months at a time, because compared to the investors who maybe buy and hold forever, that's short term. Okay, I get that. So definitions are relative, but we tend to be generally, most of us here, short term, meaning a few days. Okay. By the time you identify a significant trend, it could be over. It's true. Now, how do you trade trends? Well, my advice is that you look at the idea of phasing in and out, staggering in and out, stepping in and out, however you want to describe it. You stage in, you stage out. When you go into a trade, if it's trending, you go ahead and make the trade. And you trade it as long as it stays in the trend. Like Tripp said, it works until it doesn't. You can't get sucked into, man, this is a strong trend. I'm just going to ride this thing out. Oops, it's flagging a little bit. Now, okay, it's coming back. I'm sticking in. I'm betting on the trend. Guys, if a trend has been decent and it's following a trend line pretty well, the first time it breaks that trend line might be just a slip. Oftentimes, it jumps right back in, starts going again. But at the first sign of weakness, there is nothing wrong with starting to phase out. If you're profitable, take a little bit of the profit. If it starts to get a little funky again, take a little more of the profit. You know, if it dips below the line, take some profit out. Leave some in case it might recover. And if it starts to recover, great. Now, guys, if you jump off the horse and then the horse keeps going and wins a big race, you're going, oh man, I wish I would have stayed on the horse. I have a market maxim that says bet on both sides. When you're not sure, if you really are confused whether you should get in or stay in or get out, do both. Do both. Number one, it gets rid of your frustration and your anxiety. I closed out some of this at a nice profit, but I'm still in case if it keeps going. But I've got a very specific spot to get out if it doesn't. Oh, it rallied and it takes off. I've only got half a position, but hey, I've still got half a position. I'm still in it. You see, if the market turns and heads south and you jump out, you say, man, I'm sure glad I got out. But you're not going to have to live with the regret of, oh man, I wish I would have stayed in. Forget that, guys. That now you're just guessing. This is tactical. It's looking wimpy. I'm going to take some of my profit. If it materializes and gets more wimpy, I'm out. It's looking a little wimpy. I'm taking some of my profit. Oh, it rallied. Okay, I don't have as big a position, but I'm still in the position. It doesn't matter how big it is. It shoots way up. Extraordinarily move. These moves tend to reverse. And as it turns and start to reverse, I'll take a little more profit out. It's kind of the opposite of dollar cost averaging or when you stage in or stagger in dollar cost investing, where you go in over a period of time, you keep buying it every time it dips and it gives you an average price, yada, yada. But this is a tactical trading strategy. Phasing in, phasing out. It maximizes your probability of success. Now, there are some people who will say, nope, I'm just going to ride it out. And if it starts to drop and hits my stop, I'm out and I'll go into something else. I don't care if it rallies. All right. They're the same people that when it rallies up and they have their whole position, they say, see, I did so much better because I kept my whole position. But guys, now you're betting with the whole farm. You're either all right or all wrong. And you don't have to be. It's not about being right or wrong. It's about doing the right thing in each moment. And I think that looking at this from a practical standpoint of saying, hey, it's working. I'm with the trend. Oops, it's starting to break the trend. It might break, or it might be just a little head fake, a little bit of testing. And that's what it is. The big traders in the market will test to see if we've still got people. Guys, think about this. The big influential traders, and this doesn't matter. I mean, it doesn't change the fact that we have HFT, high frequency trading going on. It doesn't matter. When things are starting to go good, some of the big players that are benefiting from it will do a gut check. Guys, the big traders start trends. They don't drive them themselves. Nobody's got enough money to drive an entire trend by themselves. Not even a small group of people have got enough trading power to drive the whole trend. They may start the trend, but they count on the public, the public money, the big market money across a broader sector to come in and give it some horsepower, give it some legs. Now, if you are in on this thing at the beginning and you've made a ton of money and you're influencing this trade, you don't want to risk that. You are dependent. Guys, if you're one of the people at the lead of the pack, you got in first or you helped influence it, you are dependent on the rest of the crowd. What does that mean? Well, that means that every once in a while, you better make sure they're still with you. So what do? One of the ways they do it is to turn around and soften things up or actually sell, even though they're long and strong and bullish on the position, they'll sell to dip it below the trend line to see what happens. if there's a panic and they see people going, oh my gosh, I'm out, boom, they will jump out so fast and they will send a signal that will drive this thing down, way down, and then they'll pick it up again. Or they'll simultaneously sell off and sell short, which adds even more pressure. So they will just not only knock it over the edge, they'll shove it. And they'll throw rocks on top of it to make it go faster down. They're making money on the way down. And when it hits the bottom and nobody else is selling, there's nobody left to sell, then they buy it at a bargain and rally the thing up again. It's very manipulated. Trends are manipulated. That's why patterns happen. Guys, you cannot dump a load of lumber over the edge of a cliff, come back 3 days later to the bottom of the cliff and see it in the shape of a house and go, wow, that's pretty cool. It landed in the shape of a house. No, it didn't. You dumped that lumber over the edge, and some enterprising people saw free lumber and started building a house. Okay, it's not that complicated. So can you play trends? Yes. Can you recognize patterns? Yes, but be tactical about the way that you play them. Recognize they're manipulated, they're tempting, they're juicy, but they can also bite you in the hiney if the traders decide there's not enough support here, we're taking this down. And you think, well, it's a little dip, but the trend is so strong, I'm not going to panic. I'll wait. And then all of a sudden you're grasping as you're being shoved over a cliff and panicking. Okay. Last note, uptrends and downtrends can be long and sturdy. They can. But at a certain point, the market will change its directions. Timing these reversals is difficult unless you have a strategy. Phasing in, phasing out. But when the sentiment towards a particular stock gets to be too strong in either direction, up or down, then skepticism may be in order. Like I said, if you get a big move to the upside, good time to take some profit. If you get a good move to the downside, good time to maybe start dipping in. During these times, think like a contrarian and don't be complacent. That is the last piece that I think is relevant. So phase in, take profits as it's going up, but only when it threatens, so that you've got the ability to keep riding the trend. Guys, the trends aren't perfect. They don't follow lines perfectly. Sometimes they're so perfect that if they even cross it a little bit, you freak out. You shouldn't. It's still a trend. But you won't survive those little wiggles unless you've got a strategy. And taking a little profit out every time it wiggles, not a bad idea, because you don't know if the wiggle will be a push over a cliff. If you got some of your profit out at the high point, at a nice high point, and you have to panic and dump the rest of it, you still win. You still win. Pick up the pieces on the dip. Most of you don't play serious shorting. It's a little scary and it takes some chutzpah, okay, and experience. Nothing wrong with waiting till it seems like it's finding a bottom or it hits a dramatic hit and then start phasing back in. Does that make sense? Guys, I mean, if I was looking at you in the face, or if we were on camera even, I could see the head nods, I could see the expressions on the face, and I'd know that, okay, you're with me. Here I have to rely on a little bit of yups and yeses. So I got some yups and yeses, thanks. All right. Will says, or are the eyes glazed over? Exactly, that's what I'm looking for, Will. And I can't see it. So, all right, here's another one. This is a good one. This has been iterated so many times by so many great traders, investors, and that is when everybody's bullish, sell. When everybody's bearish, buy. Okay, there's so many iterations of it. I just say when others buy, when others sell, and sell when others buy. What's the point? Well, in trends, either up or down. That's not the right verbiage I had in there. How did I mess up on this slide? Well, okay, so that's, I accidentally copied the wrong little paragraph for you, but I'll just tell you. The whole idea is that, gosh, let me see if I can remember how to do get over here. That's not it. I want to do, shoot. I'm not seeing my phone. There it is. There it is. There it is. And let's see, I'm trying to look for, let's see if I can get a clear page. All right, well, let's do this. My pen out here. Mouse is going the wrong direction. Fat finger. Oh my gosh, are you kidding me? All right, so let's try this again. Go back to screen share. You know what? Maybe this was a blessing in disguise. Hang on. Maybe this will give me the. That's the one I'm looking for. Thank you. Thank you. Thank you. Here we go. Okay. All right. So I'm going to remind some of you this will be new, but this is a representation of something that's very literal. You have to take it as a representation and not so literal, but this is a real process. A, B, C, D. This is the alpha traders, men or women. It's very difficult to even know who these are. These are the very high level professional traders in trading houses, in the trading pits. These are wannabe. This is the crowd. Also a secondary level of serious investor, regular traders. And then you've got the unwashed masses, okay? The people that are in the market that don't know very much about it. This is the way it plays out. Let's say a stock has been moving down and the alphas decide this is a point, maybe we've been here before, maybe we've been before 2 or 3 times. And the alphas decide, okay, we're going in. And they start buying. This thing jumps and it rallies like this. When it does that, the next level of professionals, the B traders, who are smart enough to know that they're not the A traders. Okay, there is so much ego in the market, guys. Everybody wants to think, all the professionals want to think they're A's, but they're not. And the smart B's know that they're not. But they watch carefully to find out signals if they can find, because there is no, unless you know who they are, there's no name badge. You oftentimes that might be somebody sitting on a yacht trading at 2 o'clock in the morning on the balcony of their yacht, who's the most influential trader in Microsoft or in NVIDIA. Seriously, it could be anybody anywhere because of electronics now. Okay. So these guys, they do what they do. The guys and gals, they do what they do. The B's are smart enough to know that I'm not an A, but I know when I see an A move. I'm smart enough to recognize the A's taking a position. So they jump in. Now, this is some serious momentum that gets it started. They do not have the ability, if this is the resistance level up here, they don't have the ability to take it from the support up to the resistance, but they can get it started. Now the crowd moves in, the rest of the trading world, boom, and they drive this thing. And as it gets up close to the top, finally, the unwashed masses who've been seeing their friends talking at work about they've been in for the last months on NVIDIA or Netflix, and this thing is just killing it. They're going, well, I usually don't do this stuff, but everybody else is in it, so I'm going to get in too. So the D's finally get in, and the A's are watching this. They've learned how to read this, and they know that this can only go so far. And they know there's a reason that it hit resistance and reversed over last time. So now they're watching, and they will test. So what if the trend has been following this, guys? Watch this. Boom, boom. Then all of a sudden it does this. That was a test. And there was still some buying pressure. There's still some C's buying in on any dips. So it rallies back up one more time. Now we've got 1, 2, 3. We're into our 4th rotation. We're up close to historical resistance. And then all of a sudden this thing goes like this and it spikes up. Ooh, we're taking out the resistance. Yay. But what they're testing to see is who is willing to go farther than it's ever gone? Who's willing to go farther than the last point? that it failed at. And if there's not very much support, this comes back down and then boom. Now this right here drew in the last of the D's. It drew in the last of the C's, and the A's are going, okay, time to short. And the B's go, I'm with you, brother, sister. I'm here. And then down it goes. And now we have a target. And the C's will jump in and they will do most of the heavy lifting. And finally the D's come in and then the A's pick up the slack and go rally again. Guys, that is what happens in the market. Charles and Tripp and some of the folks that have been with me a long time know that my adage on this, my market maxim is, you're not going to ever be an A. If you can learn to read charts, if you can learn to read patterns, then what you want to do is to go with the B's. You want to be a good little B. Yeah, you're not a big professional. You don't have to be. You can see the A's and the B's making the turn. If you're smart enough to read the pattern, jump in and you ride the A's and the B's, and you get really nervous when it gets up here. Just don't be a D, Tripp says. Exactly. You don't want to be a D. Being a C is okay, coming in late, riding the trend, okay. You just got to be careful. By the time you see a trend, by the time you see rotation 1, rotation 2, rotation 3, it may be done. Oftentimes it is. Patterns go 3 to 5 times. So you got to be careful coming in with the C's. You can't be too cocky, jumping in thinking you're an A. But if you learn to read patterns, you can come in on the B. And how do you do it? You may phase in. Oh, where have we heard that before? You can say, it looks like we're starting. This pattern resembles the last one. Boom, I'm going in now. But I will add if it keeps going past this point, and I'll add again if it keeps adding the next point. Will says Brandon's zone definitions does this with good accuracy. Exactly. This is not something I invented, but I'll tell you what, this was taught to me. Okay, this was taught to me by John Najarian, and maybe John and Pete Najarian don't mean anything to some of you, but to some of us they mean quite a lot. Okay. And John explained this to me on the floor of the CBOE years ago. I went, holy cow, this is good. I get it. He said, it's a dance. It's a dance. But most people's egos as professionals, they want to think they're A's, and they sometimes jump in and nail it. And they think, hey, I'm helping influence things. And then next time they get crushed because they realize, they don't realize perhaps, but the reality of the market teaches them, no, you're not an A. Sorry. No, you anticipated. So what is the great advice here is you got to be careful when you're playing in somebody else's backyard. If you're playing in their game, in their backyard, you have a serious disadvantage. Okay. All right. So let's go back to right here, I think. All right, tell me if this comes up full screen. Here we go. Hello. There we go. Screen 2, that's screen 2. That's what I want. Shouldn't be blank. Share it out. Well, guys, we're down to the last few minutes, so I'm not going to fight this. We'll just jump in here. The next one. I like this one. We'll just take a minute on this. Bet on the jockey, not the horse. Okay, bet on the jockey, not the horse. Why? Well, it's because sound reasoning to do this, but it can be tricky because a great company can be ruined by bad management. A mediocre company can be resurrected by great management. Happens all the time. Management changes cause news and they cause market movement, tradable movement. But you got to watch, because when management changes are made, the market is skeptical and they're going to be really quick to judge. There's a lot of speculation, and there can be big movements. The monthly, the quarterly reports are highly anticipated to see if things are working. And if there's any sentiment that I don't think things are getting any better under this guy or this gal, or hey, it looks like I think that they're making a difference in this company. And now you look at the potential of the company, you think, hey, this person is going to be able to realize the potential of this company. I'm in. Okay. These are big moves that can happen. I like it. Bet on the jockey, not the horse, but be careful and know that the market is going to be really, really sensitive about this, and you can get fast movements. Next one, buy the rumor, sell the news. Guys, a lot of times when the news comes out that everybody's looking for, even if it's good news, if you've played any earnings at all in your life, even if it's good news, stocks can tank. Okay. If everybody's anticipating and you've got a trend, jump on it. Jump on it. And right before the news comes out, if you've made profit, get everything out. No. Well, you said that sometimes yeah, exactly, sometimes. So what if you've made a nice profit on a run-up, on a rumor, and it's coming up to the day that they're going to make the announcement of whether or not the rumor is true? You say, I'm going to take 2/3 of my profit out. And if this thing rockets to the sky with 1/3 of my position, I will be thrilled. If I have to panic sell this other third because the news comes out and it drops, okay, I'll still be profitable. Do the math. If I lose everything on this last few contracts, but I cash out these contracts now, will I be net positive? Yes, then do it. And guys, if you get lucky, it's a crap throw. It's a crapshoot. It's a throw of the dice. Let it go. If it goes against you, it doesn't hurt very bad. If it goes in your favor, it'll be a huge win with a small percentage. Okay. And you might say, oh, I wish I had more. That's okay. You're in it. You celebrate the fact that I played this right. If it would have tried to kill me, I would have survived it and I would have made money. If it blesses me, all the better. Right? Does that make sense, guys? Stocks often will move on speculation and then adjust when the news is official. Yes. Which way do they adjust? I don't know. It depends on the news. But if you can ride that anticipation, go for it. Don't try to catch a falling knife. This refers to the urge to buy stocks that are falling sharply. It takes a huge drop. Ooh, I'm going to buy in. It's just as dangerous to try and catch a knife as it falls to the floor. It can be just as risky to buy a stock during an aggressive sell-off. If you put your whole position in, right? If you put in your whole position, of course. But what about taking a small position? Big dips often are followed by big rallies. Big dips are followed sometimes by small rallies and then continue on in the dip. Okay, remember, you can buy a hat that has a bill on the front and the back. One says the one team and the other one's the other, and you just root for whichever one's winning. You will never make a profit on a trade that you're not in. Okay, if you're not sure, bet both ways. Take a small position and go both ways. Okay. The adage there, we've seen something marked down 10% and 3 weeks later, it's down 25%. Exactly. But you can see it marked down 10% and 2 weeks later, it's up 50%. Why? Because sometimes those A traders will really test. There'll be some bad news and they will jump on it and everybody freaks out. And they look at who freaked out and they realize that there was just a few people that freaked out, but they were chasing each other all the way down. They're going, wait a minute. That means there's a whole bunch of people that didn't freak out. They're still there. Oh, opportunity. And they will buy like crazy. And that thing comes flying back up. And by the way, a knife point, think about a knife point. It goes down to a sharp point and you don't have a knife unless it comes back up. Yes. All you got is a line. The tendency for big dips followed by big rallies is very strong. Okay, so selling as it hits the bottom is a mistake. Buying as it hits the bottom can be wonderful, but it can also be a head fake because if they sell off and then you try to rally and nobody responds, they go, oops, well, we're already short. Let's do it again. And they'll shoot it down. Volatile moves are scary. Now, what I like and what I will tell you is that if you have got a good pattern, if that volatile move drops all the way down and it stops at a strong support level, whoa, does that mean something different? Absolutely. Why did it stop there? That's not a coincidence. Guarantee you it is not a coincidence. It didn't stop there by accident. The lumber didn't land in the shape of a house. That's a strong reason to buy at that point. Heavy? Not necessarily, but definitely take a strong bullish position at a support level. When I say strong, I mean you're doing it confidently. I wouldn't take a big position, but I would have a stake, because if we have a knife, it's going to come flying back off of there. And I don't care if I've got 2 contracts or 10 contracts. If I've got 2, I got 2. I'm in it. That profitable trade is working because I did the right thing. If I had 10, would I wish I had 20? Of course. Of course, that doesn't mean anything. If you're in it, that's all that counts. You did it right. You did it right. Okay. We missed one slide. I'm going to take a few seconds on this and then I'll close with my magic maxim that I want you to all memorize. This one. Bear markets tend to climb a wall of worry. What does that mean? This is another news-related saying, this time regarding periods. When markets continue rising, even when there's negative financial news or economic news causes disquiet among the broader traders, how can the market continue to move higher in defiance of the prevailing sentiment, which seems to be bearish? In short, buyers continue entering the market, pushing it over what otherwise might be a hurdle to further growth. The C traders that are anticipating, the C traders that are bullish, they're still bullish. Even though the ground kind of shakes, they go, what was that? I don't know, man, but so-and-so still buying. Well, me too. Okay. You got a problem coming. It just isn't here yet. If you're waiting for everyone to agree on the market, you could wind up waiting for a long time. They can go up when people are still queasy and they fall apart really fast. Even though it seems like it's going good, if you don't recognize that the sea legs are coming out from under this, that's what the A traders are doing. They're watching the participation. They're watching the volume and the type of trades that are going through and the size of the trades. And they're good. There are just a few people who can read the market like a freaking book. Very few of them. A lot of people think they can. The smart ones recognize, I'm not that. I'm going to find somebody who is, and I'll follow them. I'll swallow my pride and I'll be happy to be a good bee. Guys, this wall of worry is a behavior pattern that certain people recognize and take great advantage of. Be careful you don't get sucked down the tube. And right now, we end with Ryan's maxim. The past is prologue. The last 6 months are the most relevant. The last few rotations of a pattern are the most relevant. The most relevant activity is the most recent activity is the best predictor of what happens next. When you look at patterns, don't look at the average over 10 years. If it's positive, great. What's that behavior over the last 3 or 4 years? If it's consistent, then the probability that you'll get 1 more year is quite high. Not guaranteed, but quite high. I don't care if the pattern balance or the average is very high, stretched over the last 10 or 15 years. But it's high because of a few big wins, some mediocre years and some negative years. I don't care, because now it truly is a crapshoot. All you're doing is just hoping that this will be one of those big ones. Okay, guys, no matter what strategy you use, no matter what pattern you try to identify and read off of in the market, or no matter what maxims you try to follow, past is prologue is your best predictor of what's going to happen next. I hope that makes sense. I hope you got some value out of that. Will says, thanks. Appreciate your experience and coaching. Have to get on next business meeting. Go for it. Business, business. Business is business. Take care, everybody. God bless. Have yourself a great weekend. and we'll see you next month. Take care. Bye-bye.